Are you tired of working for money and want your money to work for you instead? Imagine getting paid every 3 months, not by a boss, but by shopping malls, warehouses, and data centers across Asia. And nope, you don't need to be a landlord or deal with leaky toilets. Today, we're breaking down the CFA ETF. That's the NikkoAM-StraitsTrading Asia ex-Japan REIT ETF. It's one of the easiest and most affordable ways to build passive income through real estate, even if you're starting with just a few $100s. Stay till the end, because I'll show you why now might be the best time to invest, even with all the market uncertainty, and how this one ETF can help you become cash flow rich over time. If you're serious about building wealth without burning out, hit that like button and subscribe to Wealth for You, because this channel is all about helping you reach financial freedom step by step. Let's break it down. Disclaimer: this video is for educational and informational purposes only. It is not financial advice. Please do your own research or speak to a licensed financial advisor before making any investment decisions. Investing involves risk, and past performance is not a guarantee of future results. Chapter 1. What is an ETF and what is CFA? Let's start with the basics. What is an ETF? ETF stands for Exchange Traded Fund. It's like a big shopping basket of investments that you can buy on the stock exchange, just like a regular stock. When you buy one unit of an ETF, you're not putting all your money into a single company. Instead, you're spreading it across many different investments all at once, instantly diversifying your risk. Now, in the case of the CFA ETF, that basket is filled with real estate investment trusts, or REITs. These are companies that own income-producing properties, like shopping malls, warehouses, offices, data centers, and even hotels, and they pay out most of their income as dividends to investors like you. So instead of saving up hundreds of thousands to buy one condo, you can invest in a wide range of real estate across Singapore, Hong Kong, India, and more, all with just a few $100s. And here's where it gets even better. The CFA ETF, officially called the NikkoAM-StraitsTrading Asia ex-Japan REIT ETF, is listed on the Singapore Exchange, SGX. It tracks the FTSE EPRA Nareit Asia ex-Japan Index, which means it mirrors the performance of over 40 professionally managed REITs across Asia, excluding Japan. With just one investment, you get automatic diversification, exposure to some of Asia's top-performing real estate assets, and, most importantly, you receive passive income every 3 months through quarterly dividends. Whether you're a beginner or looking to grow your income streams, this ETF gives you a simple, accessible, and low-cost way to build real estate wealth, without the headache of being a landlord. Chapter 2. Dividend Yield and Frequency. In 2024, CFA, that's the NikkoAM-StraitsTrading Asia ex-Japan REIT ETF, paid out a dividend of approximately 4.75 cents per unit, which worked out to a 6.0% yield based on the average price that year. But here's the exciting part. The trailing 12-month dividend yield as of now is around 7.7%, thanks to stable payouts and a dip in the ETF's price. These dividends are paid quarterly. That's 4 times a year. So you're getting passive income every 3 months just for holding the ETF. It's real estate income without the property headaches. No tenants, no repairs, no paperwork. Just buy and collect. Chapter 3. Top 10 Holdings. So where does your money go when you invest in CFA, the Nikko Asia ex-Japan REIT ETF? Let's break it down. As of April 2025, the top 10 holdings make up nearly 60% of the ETF, and they include some of the largest and most stable REITs in Asia. 1. CapitaLand Ascendas REIT, 10.32%. 2. CapitaLand Integrated Commercial Trust, 10.19%. 3. Link REIT from Hong Kong, 9.57%. 4. Embassy Office Parks, REIT from India, 6.67%. 5. Mapletree Industrial Trust, 5.36%. 6. Mapletree Logistics Trust, 5.31%. 7. Keppel DC, REIT, 4.52%. 8. Mapletree Pan Asia, Commercial Trust, 3.71%. 9. Fraser Centerpoint Trust, 3.44%. 10. Fraser's Logistics and Commercial Trust, 3.43%. These are big names that manage everything from office parks and logistics warehouses to shopping malls and data centers, properties that people and businesses use every single day. Now, here's the country breakdown of CFA's portfolio. Singapore 72.11%, Hong Kong 12.26%, India 9.42%. So, even though CFA is diversified across Asia, it's heavily anchored in Singapore REITs, which tend to be more stable and transparent, while also giving you exposure to growth markets like India and Hong Kong. This mix provides both income stability and growth potential, all in one ETF. Chapter 4. Why buy CFA now? Yes, we're living in uncertain times, with trade tensions, global economic slowdown, and interest rates still higher than usual. It's easy to feel nervous about investing right now, but here's where the opportunity lies. The price of CFA has dipped, partly because of weakness in markets like Hong Kong. However, the dividends have remained steady. That means you're not just buying an ETF, you're buying a steady stream of income at a discount. In other words, the yield you get today is actually higher because you're paying less for the same level of income. And there's more. Many economists are expecting interest rates to start coming down later this year. When that happens, REITs usually benefit because borrowing costs drop and property values and REIT prices often rise. So if you believe in buying low and holding for income, this might be one of the best windows to enter. It's like buying a property when the market is soft, but still collecting rent the whole time. Chapter 5. Becoming cash flow rich. This is why long-term investing matters. When you hold CFA, you're building a stream of passive income. Every quarter, you get paid, whether you're working, on holiday, or just chilling at home. You don't need to chase the market. You just need to collect dividends and reinvest and let your money grow over time. That's how you become cash flow rich. And that's the path to financial freedom. Chapter 6. Pros and cons. Pros. Pays 7.7% yield, quarterly. Diversified across Asia. Exposure to over 40 REITs. Easy to buy and sell on SGX. Real estate income without owning property. Cons. Prices can fluctuate in the short term. Exposure to regional risks, for example, Hong Kong volatility. Dividends are not guaranteed, though historically stable. Closing remarks. If you want steady passive income, exposure to real estate across Asia, and a simple way to grow your wealth, the CFA ETF checks all the boxes. Just buy once, hold long-term, and get paid every quarter. That's the beauty of dividend-paying REIT ETFs like CFA. So if this video gave you clarity or value, smash that like button and subscribe to Wealth for You for more smart, simple ways to make your money work harder than you do. And hey, don't just aim to be rich, be cash flow rich.